Hi, I'm Tom Graffeo with Dove Investment Research and Management with
Paul Avila.
Paul and I have been friends for a long time, since 1992, and I like to joke around, we were both puppies back then. But we've seen a lot of different things in the interest rate environment, and one of the things that we're seeing today for the first time in maybe since the beginning of our career is the potential for higher interest rates. If you think back, Paul, was it Ronald Reagan and Paul Volcker, and the interest rate wars back in the early 80s when we both started in this business. Reagan and Volcker teamed up together to raise interest rates to break the back of inflation. There's a little bit of history lesson that most advisors wouldn't know. But looking back, that was the last time interest rates really went up in any meaningful sort of way. Janet Yellen recently has announced that we expect also that interest rates will start moving upward because there's really not a lot of room to move downward at this point.
No, I completely agree. Outside of this year, I would have to say we pretty much have been in a 30-year bull market for interest rates and for bonds.
So it's a real substantive change that's happening inside the markets right now. It's a really big change that's happening in the markets right now. So to that end, what I thought we'd take 5 minutes and kind of review for all those who care to look and watch. What is a bond and how it can be affected by interest rates and why it would be important to you as both a saver and a retirer. So first thing is, what is a bond? A bond is basically just a loan, right? And like any sort of loan, it has a rate, a coupon rate, an interest rate, as well as a time frame or maturity. And so that is really important because on most bonds and most bonds, the rate is fixed. So if they're paying, let's say, a 3% interest rate and new bonds come out at 4%, your 3% rate is not as valuable. So if that happens, the value of your bond goes down because a new investor would say, why would I buy a 3% bond when I can buy a 4% bond that just was issued? So this is the risk that we're concerned about for our clients going forward.
I agree, Tom. And the bond market is very big. A lot of people don't realize it's 10 times the size of our stock market. A lot of people and parts of our economy depend on bonds. Banks, for one thing, insurance companies, and of course our government, who issues more bonds than anyone. And they all depend on interest rates. Next, there's a lot of different ways to own bonds. A lot of clients own bonds in mutual funds, ETFs. They can own them directly, and oftentimes they're not even sure what they own.
So one of the key factors is in however you own a bond or however a bond is held in your portfolio for you, one of the key factors to think about is this word duration. So duration is kind of a technical term that we use in the industry, but I want to try and demystify it a little bit here for a second. Duration means how much of a time frame that your bond, how much interest rate sensitivity it has. The higher the duration, the higher the sensitivity. So we like durations in a rising interest rate environment to be low. We would like a 3 or 4 or 5% type of duration. In a lot of portfolios we're seeing today, from a lot of the other folks, we're seeing durations upwards in the teens, aren't we?
We are. In this quest for higher interest rates in this very, very low interest rate environment, a lot of clients, a lot of people with advisors have been looking for higher yields, and that entails much, much higher risk. Probably they didn't go into it realizing that because someone wants to earn 3-4%. As opposed to 1 to 2%, there comes some extra risk along that, and it's very important to realize what your duration is.
So what we would like to offer to anyone who'd like to have a review, and of course our reviews are free, we're happy to give some time to get you or anyone going in the right direction, is to do a fair and honest analysis of how the duration is going to affect and how duration affects your portfolio and what the potentials are. We have some great tools to do that. We have about 3 or 4 different tools we would use and spell out duration and show you in very real, clear terms, mathematically based, but explained in English. That's the way I'd like to present it. Based in facts, but in a way that you can understand, so that you can see what the potential is of a higher interest rate environment, where we may have a 1%, 1.5% higher by the end of 2017 interest rate environment. I think that's a fair expectation. And then beyond that, so there's some moves you can make today and prepare for that to be able to be ready for what that is and how it may affect your portfolio. How would someone take advantage of all this, Paul?
Well, what I wanted to say is it's very critical to understand what this duration means and what your duration is.
Yes, your personal
there are
duration.
clients, and some of you have bonds with a duration of maybe 15, and what that simply means mathematically is if interest rates go up by 1%,
Right.
your portfolio in price will go down 15%.
That's
and
true.
That's drastic.
That's
So
drastic.
it's very, very important to take an assessment of what your risks are and what you can do and how we can help to reposition that for you.
That's spot on, and that's the reality, and that's why we think it's so critical to have this message out there for everyone to be able to say, yes, the stock market may have less risk in it today, or may look less risky, but the whatever risk you thought was in the stock market is now transferred to the bond market, and please pay attention to that, because if you didn't like 15% down in the stock market, you're not going to like 15% down in the bond market, and that could be half your portfolio. We're paying attention to this very much at Dove Investment Research and Management. It's a key driver for what we're thinking about in 2017. We want to make sure it's available for you and that. So we offer a free consultation to sit with us, either by phone, by webinar, by any means possible. We have offices throughout Southern California. We can sit with you, do a great review for you, and really explain where your risk is going forward. How do they take advantage of it?
Yeah, give us a call, visit us on our website,
Yep.
and view a few of the tools that we have available, and we'd be more than happy to explain anything to you.
Thanks for your time today, and we look forward to speaking with you or reaching you directly.